Let us now move on to the next concept, which is, I mean, it's very easy to understand as we saw expenses being accrued or prepayments happening in terms of expenses. But how does an income get accrued? Now, this happens many a times where you receive your sales proceeds in advance. Now, when can that happen? For example, in case of a magazine subscription. Now, you normally pay the subscription for 1 year or 2 year or 3 year. A business receives a publisher of magazine will receive a subscription income for the next 1 or 2 years upfront. Now, that can happen in magazine subscription. When school and colleges collect fees, normally they collect for the whole year or 6 months in advance. Now, there you have already taken the amount of your sale in advance. Similarly, when maintenance contracts on machineries are done, they can be for annual maintenance or even sometimes 2 year and 3 year maintenance contract, where the amount is paid again upfront and the services then incurred or done over a period of time. Now, here are examples where the amount, the sales amount, the sales proceeds, the revenue has been received in advance. Such a revenue or income is called as deferred revenue or deferred income. Now, it can also be an accrued income in situations where, for example, you have paid a supplier last year of the last accounting period. You have already paid a supplier with the amount that was due to him or to that business, and it so happened later on some quality issues came up, for example, say, and the supplier said that he will refund the amount. Now, when the agreement to refund happens, at that time you will have an amount which is accrued that you have to receive, because you already paid that supplier before. So, it is not as though you can cut the amount that you can pay the supplier. It can happen that he has to refund it to you, and therefore that will be treated as an accrued income in that particular accounting period, and when the actual cash is received, that will be treated as the receipt of cash. Now, that situation, the accrued income comes into play. So, how do we treat it in terms of the deferred income or deferred revenue? To treat the advance income as a liability, because you have received what is not due now, any point in time it will be treated as a liability, and as and when the actual event happens, for example, suppose there was a magazine subscription of say 100 rupees per month, and the amount was received was 1200. Now, when the 1200 was received, the entry would be to hold it in a advance income account, say a subscription account, which is an advance subscription account, as a liability, and credit your bank or bank account. So, as the recognition happens, as the actual recognition happens, what you will do, you will debit the liability account and then credit the income or the sales account. So, let me just reiterate this once again. When you receive the advance subscription of 1200 rupees, it is an advance amount which is a liability in your books, and therefore you will debit bank because your bank account would have got credited, and credit the advance subscription account, say 1200 rupees each. Now, every month as the subscription, the magazine is delivered to the customer, you will credit the liability account with the amount and pass it on to sales. Rather, you credit the sales account with that amount and debit the liability account, thereby moving the amount into sales, which is where it should go to. So, that is how the advance income is treated. As far as the accrued income is treated, here the income will be moved into something called an income accrued and due account, and the P&L will be credited. The same time the amount is received, you will debit this account because it is a receivable for you, and credit the P&L account because it is a income for you. And when the actual payment comes in, your bank account will be debited, and the asset account, which is in this case the income accrued and due. So, moment the income accrued and due happens, you have recognized this as an income, and when the actual cash comes in, you reduce this asset, and the asset is now reflected in terms of cash in your bank account. So, this is how the accrued income is treated. Let us now look at a video clipping giving you little more insight into the same accruals concept, both in terms of the expenses and income.
This video compares accrual accounting and cash basis accounting. Under accrual accounting, we recognize events if we meet certain recognition criteria and despite whether cash was paid or received. So cash receipt or payment is not the main recognition criteria. For cash accounting, cash receipt or cash payment is the main recognition criteria, and we focus our attention on cash flow, whether cash was received or paid. If cash is not received or paid under accrual accounting, we will have accrued revenue if we sold goods but have not received yet cash, and accrued expenses if we have incurred expenses but have not yet paid cash. If we get cash in advance or if we pay cash in advance, again, under accrual accounting, we will have deferred revenue if we received cash in advance for future sales, and we will have deferred expenses if we paid in advance for the expenses which will be incurred during future periods. Under cash basis accounting, we will not have those items. We will recognize expenses or revenue when we pay or receive cash. And example is the following. If we pay insurance in advance for 6 months, it's $750. Under accrual accounting, we record deferred expenses and decrease cash, and we will split the amount in equal parts over the 6-month period and recognize expenses gradually. Under cash basis accounting, we will not do this, and expenses will be recognized when payment is made. So when we pay $750, we will recognize expenses under cash basis accounting. So this is a comparison of accrual accounting and cash accounting.
We now go on to see vis-a-vis cash accounting. When we follow the accrual method of accounting, what is the effect on the P&L and the balance sheet, that is asset or liability. Now this comparison is vis-a-vis the cash system of accounting, where you will account only as and when the cash flows into the business and cash flows out of the business. So what happens in case of accruals of expenses? Cash has not gone out of the business, but you are recognizing the expense. Therefore, it increases expense. In effect, it reduces profit vis-a-vis the cash system and increases your liability because you have to still pay the accrued expense. When prepayment happens, prepayment of expense happens, cash is already flown out, which means what? It reduces your expense when you follow the accrual accounting vis-a-vis cash accounting. It increases profits vis-a-vis cash accounting, and it increases your assets because you will show the amount that you have prepaid as an asset in your book and expense it off as and when the actual service is incurred. In case of deferred income, you don't show all the income in the accrual accounting as total income. You will only show what is relevant for that period, and therefore it reduces the income. In cash system, you would have shown the full subscription account, for example, in magazine as income, which is not the case in case of accrual accounting. So it reduces your income and therefore it reduces profits. Obviously, the amount that you have got, you have not earned it yet, therefore it is a liability, so it increases your liability. As far as accrued income is concerned, it increases income. The cash has not come in yet, but since in our example of supplier, the supplier agreed to refund, moment he is agreed or he is obligated to refund, we treat it as a accrual, and therefore increases the income, it increases the profit, and also increases the receivable amount from the supplier in our example, therefore increases the asset. So this is the overall impact of accrual accounting on the profit and loss account and the assets and liabilities of the business vis-a-vis the cash system of accounting.